It technically doesn't have it. It's like private license.
All right, how's everybody's day going so far? I mean, it's a Wednesday, so I mean, obviously it's just going to be a little bit less good than any other day of the week. That's just nature. But so I was pondering a old story. This is back from late 90s, early 2000s, back when local area networks were really commonplace at workplaces. There was a story about an IT administrator who was having problems with his system crashing on a nightly basis. Like he would come in the morning and basically the system would just be down, and he'd have to like reboot and reinstall certain packages on the system, and could not figure out why. And as it turns out, what was happening is that a lot of the Windows database platforms, they used common files for same app or for different applications. And that makes sense. It's a little bit like back when in the 1980s, when manufacturers started saying, instead of using different parts for different vehicles, let's use the same parts and put them in different ways in the vehicles in different ways. That way we can streamline our manufacturing. Well, programmers do the same thing. They use the same file for different functions and different programs. And what was happening is the security people who were there overnight, they were bored because they really didn't have anything to do. So they had installed a video game called Doom on the network, all right? And they were playing against each other on the network. And before their shift ended, they were uninstalling the program. But the program actually had a piece of code or a piece of the program, like one of the files, that was essential to the network actually being up and operational. Yeah, when they figured that out, they were, first of all, not real happy with the security personnel that they were crashing the network every single time. But they found out that there was kind of some issues that when you make a change to a system, some unexpected changes come up. Now you're wondering, why did I share this story with you all in auditing? Because this seems like it would be more of an AIS discussion. I talked with our IT representative who's here in school of business. Her name is Amy. If you've never worked with her, she's wonderful. But I was telling her about our IDEA problems, and I was saying that this is weird because, like, for 3 years we've gone without an issue. 3 years, everybody's been able to use IDEA pretty effectively. I've not had any problems. And then all of a sudden, just out of the woodwork, I've like had over half the class contact me and say IDEA is problematic, and I was like, "What the heck is going on?" As it turns out, IT, and by the way, let me preface this by saying, I'm not blaming IT in any way, shape, or form. IT does an incredible job at Truman State with the limited number of resources we have. We're a small university. They're trying to give us technology that's comparable to other universities with a fraction of the resources that other universities have. So I'm very grateful for the work that they did. And I say that I don't want it to sound like I'm complaining, because there's no way I would be able to do the work that they do. So that's on the record, by the way. It's on YouTube. Okay, it's going to be there forever. But IT apparently made some pretty sweeping changes to their computer system, though, not just the computer labs and remote desktop, everything in the system. I do not think they uninstalled IDEA before they did that. They just did this as a based on overlay, and it has had some unexpected changes to IDEA. Some people are not able to open IDEA at all. Some people, when they open IDEA, the files that they need to access are not present on the computer. Whatever it may be, it's creating all kinds of problems, and they're not parallel. It's not like every single person is experiencing the same problem. I tested IDEA over the summer, and I said, all right, this looks good. Everything was good on my end. I didn't have any problems running the programs or running any of the routines. But then I started running into situations that I haven't encountered before. So this is kind of explaining what's going on, and this creates a problem because IDEA is a big part of this course. It's actually 10% of your grade, or roughly 10% of your grade, and I think it's a good exposure to it. That being said, if we can't do IDEA, it creates a problem. Or if like only a fraction of the people can do it, I can't say, well, you can't do it, so I guess you're just out of luck, zero. That's not the way I operate. So I don't have a conclusive solution about what we're going to be doing moving forward just yet. I will say that for this week, for next week, you do not need to submit IDEA assignments if you're not able to, okay? If you're able to, I would encourage you to do so, but it's not required. I will try to make a decision by the end of this week about what we're going to be doing. There are some of the IDEA assignments that I think are very valuable, particularly the sampling activity. I think it's really important to be able to see how using a statistical analysis program can help you in doing sampling techniques. That being said, IDEA is an antiquated tool. It's only used very, very small percentage of companies, I would not be disheartened to get rid of it. I would like to have some other technology program, but we're too far in the semester for me to include it. What I'm leaning towards right now is that I'm probably going to give everybody credit for the first and second idea assignments, which is chapter 1 and 2 was the first one, chapter 3 was the second one, and then canceling the remaining assignments. Okay. The good news with that is that's less work for everybody in this class. Okay. Which in favor of less work versus more work, most Truman students are like, less work, please. Okay. Now, if you are one of those people that wants more work, come talk to me. We can help you get your fix some other way. The bad news of that is that's, like I said, about 10% of the grade, which means that your grade basis is going to be much more heavily weighted on the remaining work, which includes the exams. I don't really have a good solution for that. Okay. I guess the good news is that if you do well on those assignments, then the heavily weighting is good for you. If you struggle on those, that's the problem. That is kind of what I'm leaning towards right now. I will let you know conclusively when we come back to class next week. For right now, do not worry about the idea assignments. If you want to complete chapter 4, just because you're like, I dig an idea, this is really, you'd be the first in generations to do that. But if you want to complete it, that's fine. You're not required to at this point. What I think we will be doing is for the idea assignments that I think that are really important, particularly the one on chapter 8 and 9, which is sampling. I think we're going to meet in 1420 for that class period. If you can open idea and access the platform, then we're going to work through the activity together. If you can't, then you can just watch me and work on it. Ultimately, the stuff that we're going to be doing, I'm not going to test you on. I'm not going to ask you questions about how to do stuff in idea, but I do think it's important to see what the difference is between doing statistics on paper versus, or sampling on paper versus sampling using a computer. And so that's kind of where I'm leaning right now. I will, again, we'll let you know for sure if something changes happens. I don't think it will be. The person who's responsible for maintaining the remote desktop system is out for the next week. So I've emailed her and I said, is there anything we can do? And the answer is there probably isn't going to be anything that's changing until after Labor Day. And even then, I'm not optimistic. So I don't want to get your hopes up if you were just kind of like, yes, no more idea. I'm not 100% on that. I'm about 70 to 80% right now. Okay, 70, 80% on that right now. With that, one thing that we will not be getting rid of is homework. Okay, we will be continuing to do the homework. So yeah, all right, good times. I mean, you all have put such hard effort into homework, writing out your answers and telling me what it is you thought about it. So yeah, we might as well talk about it. So let's go ahead and let's get working on homework. Let's talk a little bit about what the assignments are. Okay. 317, before accepting an audit engagement, a successor auditor should make specific inquiries to the predecessor auditor regarding the predecessor's what? And now this is an easy one to approach because we're just going to go each of the answers and we're going to talk about them real quick, okay? So A, awareness of the consistency in the application of generally accepted accounting principles between periods, okay? This might have been a good statement if it hadn't been for that last part about between periods. That's a little bit weird. Why would you talk about what happened between periods? So even then, it's not a required communication and not one of the required communications we talked about. So A is out. Evaluation of all matters of continuing accounting significance. Remember, we talked about being very, very careful about absolute statements. We could talk about some matters of accounting significance, but definitely not all matters. Opinion of any subsequent events occurring since the predecessor auditor's report was issued. This might be something that we inquire about. We talk about subsequent events, but we definitely would not talk about an opinion because remember, opinion represents an established position on something which is documented in a report. So opinion in this situation is something that's they would have to be paid to issue that. So we're not going to talk about an opinion in the situation. So we can toss out C. That leaves D. Understanding is the reason for the change of auditors. That's something we talked about. Yes, it is. And that is in fact our answer because we want them to understand why it is that we're becoming the new auditor and you're the old auditor, and that clarification needs to be made. So D is our answer. A written understanding between the auditor and the entity concerning the auditor's responsibility for fraud is usually set forth in the what? Well, let's go ahead and let's talk really quickly because we've only actually encountered one of these documents, and that was the document that was discussed in these presentations. So that probably should have been your answer. Okay, you should have probably said, in your solution, in your response to the solution that said, given that this is the only one we talked about, it's the only possible answer to this, Dr. Barnes. And the answer is yes, that's correct. It's engagement letter because that's the only one we discussed. What is the engagement letter again? What does that represent? It's a contract between management and the auditor regarding each different group's responsibilities and the objectives of the audit. Are there different things that can be included in there? Well, I would say the auditor's responsibility is one of those. Does anybody remember what the 3 items are that are in the engagement letter? So the objectives and scope of the audit, okay, manager's responsibility and auditor's responsibility. So this is one of those 3 items that we talked about. So that would be one of those relevant ones. What about the rest of these? Are these things that we are going to discuss? Answer is yes. We're going to talk a little bit about communications that occur. There's not really a thing called as an internal control letter. There are communications with respect to internal controls, which we'll talk about when we get to chapter 6 and 7. Letter audit inquiry that occurs near the end of the audit, that goes to the lawyers. Okay, we have to communicate with those dirty lawyers, you know, and find out what they know. Okay. Management letter, that is something that we'll talk about. The management letter is a little bit weird because it's addressed like it comes from management, but it's actually written by the auditor, so it's kind of strange. But we will talk about all of those, but these are not in the planning phase. These are closer to when the audit's going on or near the end of the audit. 319. If the independent auditors decide that it's sufficient to consider how the work performed by the internal auditors may affect the nature, timing, extent of audit procedures, they should assess the internal auditors what? So basically what we're asking here is, we want to use the work of the internal audit function because they know more about the operational organization than we do. But we can't just do it without considering some things, some factors, okay? And remember, there were 3 factors that we said we had to specifically look at. 2 of those are listed up here, all right? Would it be competence and objectivity? Yes, it is, okay? Does anyone remember what the 3rd one is? Systematic and disciplined approach. And the only reason that one's not given in this particular scenario is that, excuse me, it depends on the standards that we're dealing with. If we're dealing with just AICPA standards only require that we evaluate objectivity and competence. PCAOB standards require we also evaluate systematic and disciplined approach. Okay, so that's the reason those are listed. For purposes of this course, you should just remember all 3: objectivity, competence, systematic, and disciplined approach. All right, 320. During the initial planning phase of an audit, a CPA most likely would do what? All right. This type of question will come up many times in your homework and will frequently come up in your exam. So be prepared for this type of question. This is a phase question. So you do need to be prepared to identify what occurs during each phase of the audit. We already have been exposed to the planning phase. In fact, that's the only phase we have any familiarity with because we haven't talked about risk assessment. We haven't talked about test of controls, haven't talked about substantive testing. We only know planning and what happens during planning, okay? Do we identify specific control activities that are likely to prevent fraud? Probably not. That sounds like it would be something that takes place later on. Earliest that would be risk assessment, but even then it's probably going to be more appropriate to test of controls. Evaluate the reasonableness of the entity's accounting estimates. What do you need to have in order to be able to evaluate reasonableness of estimates? You need to have financial information to be able to do that. We have not reached that point yet in the audit. They've not provided us any information. Discuss the timing of audit procedures and entities management. Does that sound like something we do during planning? It certainly does. In fact, that sounds like the only thing that we would do during, or one of the only things listed here we do in planning. Not the only thing we do during planning, but the only thing listed up here that we do during planning. Inquire the entity's attorney if it's probable if any unrecorded claims will be asserted. Remember, we talked about that letter of audit inquiry just a second ago, said that's at the end of the audit. That's going to be, whenever you see the attorney come up, it's like, okay, that we're going to put the attorney off till the very end because we want to stay as far away from this as possible, okay? If it seems like I'm really harsh on attorneys, he's like, you guys only know Professor Templeton, okay? Professor Templeton's great, okay? He's one of those rare lawyers that people actually like. I actually like him, and I hate to say that. You know, before that, we had people like Alan Davis, which you guys never got to encounter, who was another lawyer. He actually taught tax before Dr. Dearest got here. You want to talk about slimy attorney? That's what we're talking about right there, okay? So if you hear me say the words Alan Davis, you should just automatically cringe a little bit inside, all right? 321. As generally conceived, the audit committee of a publicly held company should be made up of what? All right, so as generally conceived, what's going to be making up those the audit committee? Well, let's go ahead and go through each of the answers. Representatives of major equity interests, preferred stock and common stock. I mean, yes, that could be a part of it, but that's not the only application. There are definitely more specific information we look at. The audit partner, the chief financial officer, the legal counsel, and at least one outsider. So what did we say that they had to be outside independent board members? Okay. First of all, can the audit partner be on the board of directors of an organization that they're auditing? No, they can't. That's a big violation of independence right there. Chief financial officer, will we say that they're outside? No, they're member executives of committee, which is a big no-no. So B can't be the correct. Representatives of entities management, investors, suppliers, and customers. That seems to be problematic as well, because none of those parties is really outside / independent. Members of the board of directors who are not officers or employees. All right, I think we've got our answer there. Remember, outside independent board members. What was the other criteria for the audit committee? There had to be at least one what? Financial expert, somebody who knew about the application of GAAP and has performed that task within the context of a financial statement audit. Good. All right, 322. When planning an audit, another question about the planning phase. Auditor should consider whether the extent of substantive procedures may be reduced on the results of tested controls. Well, in order to consider that, don't we need to actually conducted tested controls? Probably so. If we don't know what the results of tested controls are, then we can't really make that justification. So A is out. Determine overall materiality for audit purposes. Is that something we studied in this chapter? Yeah, that's probably something that's going to be relevant to the planning phase too. So B is our answer. Conclude whether changes in compliance with prescribed internal controls justify reliance on them. Those are internal controls again. Have we looked at internal controls at all yet? No. We are going to look at them. We're going to look at them a lot, okay? But we're not there yet. We're not there yet. Evaluate detected misstatements. So to evaluate detected misstatements, we actually have to conduct testing. We actually have to test the things that management's making assertions about. We have not conducted any testing yet. We will get to that, I promise. You guys got that to look forward to? I promise it's going to be an exciting time. All right, the entire semester is going to be an exciting time, especially since there's no more idea. Yeah, so we will look forward to that, but we're not there yet. We're not quite there yet. All right, 325. Tolerable misstatement is what? What have we got here? The amount of misstatement that management is willing to tolerate in the financial statements? No. Important to note, this often gets confusing. Management has no say about what the auditor's assessment of materiality is. This is an audit-only determination. Management will never see this. We will never share this openly with management. It may be disclosed later on, but it will not be disclosed during the phase of the audit. So management has no input on this. Materiality for the balance sheet as a whole. Okay, well, first of all, we know that tolerable misstatement is not for the financial statements at the financial statement level. It's going to be at the account or disclosure level. But if it were, it would be the financial statements as a whole and not one individual financial statement. So that gets rid of B. It also gets rid of C, which means we got D, materiality used to establish scope for the audit procedures for the individual account balances or disclosures. Okay, so tolerable misstatement is what we say, this is the amount for this individual account that we're going to set materiality at. If it exceeds the misstatements in this account exceed that amount, we've got a problem and need to restate that. There needs to be an adjustment. Okay, in that particular situation, that's where we'd say look at tolerable misstatement. So tolerable misstatement, account disclosure level. Which of the following would an auditor most likely use in determining overall materiality when planning the audit? Okay, so let's go ahead and go through the answers again. The anticipated sample size of the substantive test. Okay, so sample size, could that affect it? Usually sample sizes are going to be after the fact, so probably not. The entity's income before taxes for the period to date. What do you guys think? Does that sound like a good answer to you? That was our quantitative basis, so I'd say that's probably a really good one. That's probably a good one. So it's B. The results of tested controls. Again, materiality occurs before we test anything. The determination of materiality. And the contents of the engagement letter. We have talked about the contents of the engagement letter, but in our discussion of materiality from on Monday, did we talk anything about what's included in the engagement letter with respect to determination of materiality? No. So those are two separate considerations. Yes.
So does management, are they allowed to see what you're using for materiality basis, or would that be a conflict?
So yeah, we would not necessarily disclose that to management, because if management knows what those amounts are, then they can actually adjust information in that circumstance. One thing that we'll find out when we get a little bit later on the course is that we have to be very, very careful about what information we share with the client, because if the client has access to our testing or what our approaches are, then they can adjust, they can manipulate information to align with our expectations. So materiality is generally one of those ones that we keep close to the vest. Okay, good question. Moving on. We got some problems here, some problems about materiality. Oh, we got trouble right here in River City. Okay, So some scenarios. What you're going to be doing is you're going to be determining overall materiality, tolerable misstatement, and audit findings. And remember, I gave you some instructions in the assignment. I said you're going to determine maximum tolerable misstatement. That was what your goal was, is not just tolerable misstatement, because tolerable misstatement's different for every account. We want to know what is the maximum amount that we would assign for tolerable misstatement to a given account, to any given account. So Murphy & Johnson is a privately owned manufacturer of small motors for lawnmowers, tractors, and snowmobiles. The components of the financial statements are listed there. I'm not going to go through each one of them. So let's go ahead and determine our amounts. So first of all, what would be a good basis, you think, for materiality? What do you think?
5% of
Yeah, I think 5% of income before taxes. That's pretty reasonable. So if we use 5% of income before taxes, then we probably are looking at, look at the solution. So what overall materiality, 1.05 million, so 21 million times 5%. Okay, so that seems pretty good. Okay, then we're going to determine maximum tolerable misstatement. Now, what did I say the percentage range that we actually use for maximum tolerable misstatement is? 50 to 75%. So any percentage that you choose to use in that could be a maximum tolerable misstatement. And we can adjust that if we think that there's more risk. Let's just go ahead and let's use easy math. If you use 75%, that's fine here. Okay, I'm going to use 50% just to make things a little bit easier, because multiplying 1.05 times 50% is 525,000. Okay, makes it a little bit easier to do some math. All right. So those are all pretty reasonable. So by the way, for income before taxes, this is a profit-oriented company. Yes, it is. Okay. Yes, it is. And absent any other information, we don't have any reason to adjust to make it lower than 5%. Could there be considerations if we had more detail? Certainly, but we don't really have that here. So we're just going to say 5%. Seems like a good number. Oh, during the course of the audit, Murphy & Johnson's CPA firm detected 2 misstatements that aggregated to an overstatement of income of 1.25 million. So let's evaluate audit findings and justify your decision. So what do we think? 1.25 million, is that a problem or not? It is a problem, okay? Remember, we said that our planning materiality was 1.05 million. This is greater than our planning materiality. In other words, if we accept that those misstatements are accurate, so just for context, because this always gets confusing since we haven't talked about testing. We tested all the items that we wanted to test as part of our audit. We found 2 misstatements, actual misstatements, that in total, these 2 misstatements totaled $1.25 million. So we believe as auditors that our clients' financial statements are misstated by 1.25 million. The question is that okay or not? And our conclusion is no, it's not. That is greater than our planning materiality. Therefore, we believe the financial statements are materially misstated. How do we correct that problem? What is going to be our solution here? We're going to go up to management. We're going to say, look, you've got 2 misstatements and they're large enough that they represent material misstatement of the financials. You need to make an adjustment to one or both of these accounts to make it less than that 1.05 million. Otherwise, we cannot sign off on the financial statements. And for context, we probably would not tell them the 1.05 million. We just recommend an adjustment for a certain amount. We'd say, can you make an adjustment to accounts receivable for $500,000 or something like that and try to justify our decision. So we'd actually recommend the adjustment. If the adjustment was accepted, if they book that adjustment, we'd say financial statements are free from material misstatement. If they do not make that adjustment, we would say, except for the items listed below, the financial statements are free from material misstatement. That would be our conclusion. All right.
So wait, you adjust the accounts so they're each under the 525,000, or just adjust so it's under the plan?
So if one of the accounts was greater than the maximum tolerable misstatement, like say we had one account that was $1 million and one account was the other 250,000. Depending on what we assigned for a tolerable misstatement in the account, we would make that adjustment. We didn't really talk that through simply because the aggregate number of those misstatements was greater than planning materiality. So we knew an adjustment had to be made regardless. But let's say that, for example, this was not above planning materiality, but each of these amounts were greater than tolerable misstatement. We would still go to our client and say, look, in total, your accounts are fine, but you've got 2 very large misstatements that we need to address because they're misstating the balance in these individual accounts. And so we would actually propose adjustments to those individual accounts. We're actually going to look at an example of that where a tolerable misstatement is the more relevant concern here in just a second. All right. Delta Investments provides a group of mutual funds for investors. The components of financial statements are listed. So overall materiality. What do you guys think? Overall materiality, should we continue to use income before taxes? What is the problem with using income before taxes in this particular scenario? This is a mutual fund. This is an asset-based entity, okay? So the amount of assets that they maintain to generate the income is substantially larger than a normal organization. If you do the math, if you just look, income before taxes is 40 million, total assets is 4.3 billion. That means income is less than 1% of total assets. So that would make our materiality amount very, very small relative to the size of the organization as a whole. So in that case, let's go ahead and let's say we're going to use total assets, okay? Total assets, and I'm going to go ahead and arbitrarily, I say arbitrarily, I'm going to use what the solution says. The solution says, let's go ahead and use 0.5% of overall materiality. Now, the reason why is that number is still really, really big. You could have used 1% and that number would have been twice as large. But let's just go ahead and think about what the context would be. If I use 0.5% of total assets, so 0.5% of total assets, my materiality, my planning materiality is 21.5 million. Let's compare that to what I would use if I used 5% of income before taxes. What's 5% of 40 million? It's like 2 million. So 21 million versus 2 million. Which would you rather audit? This is a personal assignment. I'm going to assign you guys to groups. One's going to audit the same company. You're going to audit the same company, but one of you is going to have to do 21 million and one of the groups is going to have to do 2 million. Which group is going to do less work? The 21 million group, okay? The 21.5 million group. So 21.5 million is our planning materiality. Half of that's going to be 10.75 million. All right, so we've got some large numbers here. Let's go ahead and look at our results. Two misstatements, the overstatement of income of 5.75 million. Okay, assuming that we use 10.75 million as our tolerable misstatement and 21.5 million as our planning materiality. But what do we feel about this 5 point something million? Don't care, okay? Kind of weird to say about 5.75 million. It's like, it's a drop in the bucket. For this company, it kind of is, okay? They're so large that they don't care about that level of misstatement. So we're just going to say 5.75 million, that is not enough to affect the decisions of the users of the financial statements. Swell Computers is a public company that manufactures desktop and laptop computers. The components of the financial statements are listed here. Overall materiality. So at face value, would it be okay to use income before taxes? They are a public company. So we can say publicly traded company, it seems reasonable. What is the problem with using the publicly traded company or using income before taxes here?
Super low. It
is very, very small. Their total assets are 2.2 billion, but their income before taxes is 500,000. 5% of 500,000 is $25,000, guys. So I'm going to put somebody in a third group and they're going to have to do one for 25,000. This is somebody who will not get any sleep this semester, okay? They have to test almost everything. So yeah, we can't use that number. It's too small. So in that case, we probably want to use total assets or total revenues. The book actually advocates for the same approach as before, 0.5% of total assets, which is going to be 11.0 million, 11 million. And then half of that for overall material planning materiality, sorry, for tolerable misstatement will be 5.5 million. So 11 million for planning materiality, 5.5 million for tolerable misstatement. Okay, we're good with that. If we look at the issues, it says they had one misstatement that resulted in an overstatement of income by 1.5 million. Now we've set our materiality levels that 1.5 million should not make a difference. But there is a caveat here. Did anybody catch what the caveat was here? What the issue is? Yeah, it's in income. It's overstating income by 1.5 million. What is income currently? It's currently positive by 500,000. If they're overstating income, that means they made income a positive number through this misstatement. If we make them book this misstatement, it'll be a negative number. We can't just let them go on that because, again, this is shifting from a positive number to a negative number, which is one of those qualitative factors we talked about on Monday. One of those concerns. Even if this is a massively large company, if it's a small shift that would change income from positive to or negative to positive, we cannot let them have that adjustment because that means that they're just manipulating financial statement information, which, as we'll learn in chapter 4, is called fraud, so we don't want that to go on. So in this case, we would have to just say, look, this is not a material amount, but it's enough to affect your financial position from being a profit to a loss. So you're going to have to book an entry to adjust for that, which, by the way, your client would not be happy about that. They would say some very choice words your way. So as personal experiences I've had, in that situation. All right, scenario 4. Emma's Design is a for-profit clothing manufacturer. What's the financial statements are? Income before taxes of $3.5 million, total assets of $33 million, and total revenues of $95 million. Emma's Design is considered a moderate risk audit, but accounts receivable is determined to have a higher risk of misstatement. So this is an important point to make, is that we're going to determine overall materiality and tolerable misstatement. So we can say 5% of pre-tax income is certainly reasonable. All right, this is a for-profit company. 5% of pre-tax income is $175,000. Which means that if we use 50%, that their tolerable misstatement is $87,500. Okay. So then we look at the situation. It says that one misstatement is 90,000 in accounts receivable, and a second misstatement is cash is equal to 10,000. In total, we can say that these misstatements do not exceed our planning materiality. So the total misstatement is $100,000, and we said that our planning materiality was 175,000. So in that situation, we're fine. We're just kind of like, okay, this is not a big deal. In aggregate, the financial statements are not misstated. However, it said this is a situation where accounts receivable has a high risk of misstatement, and we set our maximum tolerable misstatement at 87,500. And if you look at that one account, in that particular account, which is our high risk account, it is misstated by 90,000. We cannot tolerate that amount of risk in that account because we think that there's a propensity for misstatement in that particular account. In that situation, we would step in and say, look, financial statements are generally good, but this account is one that we focus on because of the nature of your operations. It cannot be misstated by this amount. You are going to have to book an adjustment to this account. Again, your client probably would not be happy about that because they'd say this is not a material amount, but for this individual account, this is considered to be material. All right. Fun with materiality. Any questions, guys? All right, let's go ahead and talk about our discussion case. Now, we are going to be looking forward a little bit on this one. I think this case is interesting, but it does require some judgment that you may not have the experience to actually go into full detail on yet. But I do want to talk about this because I do think this is the kind of critical thinking that you'll need to experience and expose yourself to moving forward in the course. So Forest Crest Woolen Mills is a closely held North Carolina company that has existed since 1920. The company manufactures high-quality woolen cloth for men's and women's outerwear. Your firm has audited Forest Crest for 15 years. So the good news is this should be somewhat familiar because this sounds like another retail clothing manufacturer. 5 years ago, Forest Crest signed a consent decree with the North Carolina Environmental Protection Agency. So by the way, you saw consent decree. What is a consent decree? 2 words, Dr. Barnes. One's consent, another's decree. And, yeah. So get in the habit of when you see terms like this, that you go to Google, you've got information at your fingertips and say, what does consent decree mean? So what is the definition of a consent decree? It's an agreement or settlement that resolves a dispute between two parties without the admission of guilt or liability. So basically they did something wrong and they said, look, if we fix the problem, can we get away with not having to admit that we were wrong in the situation? And the EPA said, absolutely, that's fine. The condition for this is that they have to actually fix the problem in order to meet the terms of the consent decree. So the company had been convicted of dumping pollutants into the local river. Consent decree provided that Forest Crest construct a water treatment facility within 8 years. Now, keep in mind, the consent decree started 8 years, or it was started 5 years ago. They have 8 years since the date of the admission or the date of the consent decree to finish this. So we're 5 years along. What's going on? You were conducting the current year audit and you notice there's been virtually no activity in the water treatment facility construction account. Your discussion with the controller produces the following comment: because of increased competition and lower sales volume, our cash flow has decreased below normal levels. You had better talk to the president about the treatment facility. All right. The president tells you, you know what, given our current cash flow levels, we had 2 choices: lay off people or stop working in the facility. This is a poor rural area of North Carolina, a few other job opportunities for our people. I decided to stop working on their water treatment facility. I don't think the state will fine us or close us down. Well, that's good. He doesn't think the state will close us down. So we're good. Let's just move on, okay? No, we gotta ask this. So when he asks the president of the company will be able to comply with the consent decree, he informs you that he is uncertain. So discuss the implications for the audit and the audit report. How should we feel about this as auditors? I would say very, very tentative in this situation. We would be very concerned about this. This is something that represents a substantial risk to the organization. As part of the planning, we probably would say, all right, they have 3 years to get their act together and they need to do it ASAP, because this is a situation that if the EPA is not happy in 3 years from now, they will shut the business down. And shutting the business down is going to be the worst case scenario. That's basically to say they don't have to worry about whether the financial statements are materially misstated, because they will have no financial statements. All right. So this would be one of our concerns of the planning phase, is saying what activity has changed since the last period. We need to know what's going on. We've actually talked to the president, says, you know what, we're not moving forward. That would not be a satisfactory answer for me. I would say, yeah, that needs to change in this period. Otherwise, things are going to go south. That's basically the answer to the first part, but then they throw another monkey wrench in here, all right? Would your answer change if these events occurred in the 7th year after the signing of the consent decree? So we're not 5 years in, we're now 7 years in. At the end of year 8, they have to have a water treatment facility, which currently does not exist in any way, shape, or form. It's not got any infrastructure, has not any progress. Is it likely that they will actually be able to complete the terms of this consent decree? No. So what is your just your intuition? What would you say if you were the auditor here? Says you guys are up a creek and not the creek that your facility is next to. It's a different type of creek, which I'm not going to use the vernacular, even though I realize that's an English idiom. So there's a problem. There's definitely a problem, and it does not look like it's a problem they're going to be resolved. We're going to discuss this much later in the course when we start talking about opinions. But one thing that we can add to our opinion is we can add to concerns, and you may have encountered this in your financial accounting, is something called a going concern opinion or going concern statement. Going concern basically means that we have substantial doubt that the entity will be in business next year. This happened a lot during the pandemic. Okay, a lot of companies had to actually put this information in their financial statements. It's required by GAAP to say there's some concern that we may not be in business simply because the pandemic has disrupted our operations. Can we say that this is probably a situation where a year from now, if nothing changes, that they probably will not be in business? I think that's an adequate statement. Now, again, this is something that's outside of the scope of what I expected you to answer here, but I think that you probably should have concluded that at 7 years, there's a massive problem here. And it's a problem that has to be addressed in this course of the audit. So interesting stuff there. All right, let's move on to our final item, which is going to be our materiality. So I had you all work out a materiality workbook, and someday I'm going to have enough time in class that I'm going to have everybody present their materiality solutions and see exactly how different everybody's answers were. That being said, I would say that I've probably taught, let's see, on average over the 9 years that I've been teaching this course, this is actually the 8 years I've taught this course, so this is year number 9 teaching the course. Let's see, roughly 50 different students that I teach every year, 50 times 9, 450. So 450 to 500 students, I would say that I probably have, unless the students have worked together to come up with their solutions, they've never been a consistent set of solutions for this. All right. So as we go through this, I want you to understand that if your answers differ, that is fine. I am not looking for you to have the exact same answers as I do. I'm looking for you to be able to justify your position on every single one of these answers. So let's go ahead and talk really quickly about the easy part. The easy part was you had to set planning materiality. And the instructor solutions, they say pre-tax income, and they say 4.5%. Before we get too wound up about the 4.5%, let's talk about the pre-tax income. Is everybody happy with pre-tax income being as the basis of materiality for the organization? Yes.
If you have it in the drop down, but wouldn't an average be better because your pre-tax income is.
So that's a really great question. Okay, and there is some volatility if we look at the income statements. We can look at their income. I guess what do I look for? Income before taxes. It's 70 million in the current year. It was 35 million last year, which is just double what it was, and then it was higher. It was like 50 million the year before that. So the question then becomes: is that volatility? What do you guys think? Does that mean volatility to you? I think I see Hudson's perspective in that there is some movement in there. So what would be the natural conclusion if we didn't want to make that judgment on our own, we wanted to determine this on our own? What would be the very first thing you would do as an auditor? You're a brand new spanking first year auditor trying to do this. What would you do? Say, I'm going to go talk to my senior associate whose name happens to also be Dr. Barnes for some reason. Okay. And I'm going to ask him, and you know what he'd say? He says, what does it say in our materiality guidelines? What does it say in the materiality workbook or the materiality guidelines? So let's see. I don't think I have them embedded in this particular solution. Let's see if I've got them online. Okay. Oops. What do we got? Oh, I wanted to bring it up so we could actually see. I thought I had the materiality guidelines on that, but Wilson has material. I don't, unfortunately. Okay, so I'll just ask you guys. Maybe I do. Hold on. Maybe I do have it in here. Nope, I don't. I don't have it in here. So materiality, the materiality guidelines say something very specific with respect to volatility. Did anybody capture that? So in the materiality guidelines, it says volatility is defined as moving from income position or profit position to a loss position and back and forth. Is that what is happening here? No, okay. So what you said is there's actually some consideration, and we're going to talk about that in a second, but I do not think it's enough to actually justify moving to a different position simply because we do have volatility. We do have changes in amounts. It's not enough to amount to volatility according to our materiality guidelines. Okay. That being said, you do bring up an interesting point. If I use my same basis that I used last year, if I use pre-tax income at 5%, the amount of planning materiality I use in the current period is going to be massively more than what I used in the previous period, because it was 35 million in the previous year and it's 70 million in the current year. So there might be an argument that we need to make an adjustment, a qualitative adjustment. And that is the reason why this is 4.5%. Not because of any of the other factors, but because there's some concerns that this is so much larger than the amount we used in previous periods. Now, did I expect anybody in this room to know that? Absolutely not. Okay. But I did want to discuss that. And you actually saw into part of that. So it was just a little bit of a different area to look at. So they actually recommend planning materiality of 3.157 million, which I think your answer should be around there. If you use 3.5 million, which was our basis last time, it's fine. If your number is smaller than this, it's going to be a lot more challenging. If your number is massively larger than this, you're probably giving a little bit too much leeway. Okay, so around 3 to 3.5 million. All right, let's go ahead and talk a little bit about some of these. So we've already talked about cash and cash equivalents. Okay, we said cash and cash equivalents is not expected to have misstatements, as easy to audit. Why is that the case? Let me ask you this. If I were to say, can you tell me how much cash you personally own, you personally possess? Could you answer that question pretty easily? Yeah, and when I say cash, I'm talking about anything shown in a bank account. You can open your wallet, you can say, okay, Dr. Barnes, I got $2 here, and then I'm going to go get online and look at my bank account, and I've got $1.55. Okay, and hopefully you're not in that cash position, but you can actually tell me the aggregate of those numbers pretty easily. Okay, you can tell me the aggregate of those, and that's the same for an organization. Okay, there may be more detail than that, but for the most part, it's not a difficult task to perform cash analysis. Receivables. We didn't talk about receivables on Monday. Does this company appear to have a lot of receivables? They've got some. They've got 8 million, but is that a large amount relative to their cash and to their accounts payable? So this appears to be a business to consumer organization. So think about the different types of organizations you have to operate. You've got business to business, which is one business that does business with other businesses. Okay, and they've got business to consumer. What is a characteristic of business to business? It's the granting of credit. Okay, so you say you're going to have multiple invoices over a period. I'm going to grant you credit. You'll pay all those invoices off at one period of time. Is that the way the business to consumer operates? Like when you go buy something on Amazon, do they say we're going to grant you credit and then you can actually just pay it off in mass when you buy your next 5 purchases? Amazon's like, pay me now. You say, well, I use my credit card. That's still going to be a pay me now situation. That's just basically somebody else is paying for you now and you have to pay them back at some point in the future. So receivables generally not very, very large here. So in that situation, it's going to be the items that are going to be listed out for some period, and which like their credit card accounts that are going to be 3 to 5 days, not expected to be difficult to audit, not going to be something that's highly used. All right, prepaid expenses. Prepaid expenses, is that something that you all are familiar with? You have prepaid rent in your everyday lives, okay? Yeah, hopefully you all have some familiarity with prepaid expenses. That was something you learned in 220, one of the very first things you learned, because you were trying to understand the nature of accrual-based accounting, and they said, here's prepaid expenses. So is it pretty easy to understand and follow? Yeah, as long as you have a basic understanding, auditing them is pretty straightforward as well. Cumulative depreciation and amortization. One thing we're going to find out here is this is a larger amount, so we've actually put a large number here, but we're going to actually use estimation techniques to determine what those amounts should be. Now, we're going to actually learn about, when we get to our evidence session, we're going to talk about something called analytical procedures, which is one of our types of evidence. Basically, that's using an estimate to determine if an amount is reasonable. So if I asked you to develop an estimate for depreciation expense in the current period, and I gave you all the necessary inputs, could you do that? Let me ask you this. Does anybody in this room know how to calculate depreciation? If you're shaking your head right now, then I'm going to send you back to 220. I promise you, I'm going to send you back to 220 right now. So if you know the basis, if you know it's straight line depreciation, if you know the number of years, if you know the residual value, it's really easy to calculate. We can do the same for all assets that are in the organization if we know all their bases. And we can do that in a spreadsheet fairly easily. So this would be something that we say was pretty easy to test. Intangibles is kind of interesting. So intangibles is a small account. It's only 1.7 million. But who in this room feels they've got a strong grasp of intangibles? By the way, if you raise your hand, I'm going to call you a liar. Actually, I'm going to put my hand down too. Only Dr. Ison knows intangibles, and that's because his name is Dr. Ison, okay? Starts with the letter I. Intangibles, very, very challenging. Very, very challenging and subjective, prone to judgment. It's very, very difficult to understand how intangibles work. So if this was a larger amount, we'd actually allocate a lot. As it is, we're actually allocating 17% of the account balance. The only reason that this is actually even getting some kind of concern is our intangibles increased from 423,000 to 1.7 million from the next period, which is a pretty profound change. So even though this is a small amount relative, it's a really large amount considering the account size. Accounts payable, we talked about this. We want to make this number pretty large because it is one that's frequently used. Accrued liabilities, there are some misstatements expected because remember, when we start talking about accrual-based accounting, we start getting into situations where there's subjective consideration, there's professional judgment used. Accrued liabilities are examples of that, so we'd want to actually perform more testing. And then finally, income taxes payable and deferred income taxes. So income taxes are one of those weird things that if you know what the computations are, they're very easy to do. But learning the computations or understanding what the computations be, those can be really challenging. That's why we've got an entire track in our master's program to actually learn that stuff, okay? And which if you're going to ask me, if you're going to come to me in the master's program and say, Dr. Barnes, can you explain this to me? I'm going to say, is it tax? The answer is no, all right? The answer is no. We've got 2 professors for that, so we need 2 professors instead of just the one we need to teach auditing, okay? So ultimately what we're kind of coming up with is that these are going to be different allocations based on the size, activity, complexity, and risk. And we're going to evaluate all of those for subjective assignments of those numbers. Now, again, I do not expect every single one of your answers to align. If every one of those answers do align, do you know what you're using? You're using a solutions manual, okay? I will tell you right now, I could look at this, I could study this for like 20 minutes, and then I could try to replicate it. I would not come close, all right? I would have numbers that were in the range, but I wouldn't have the same answers. Ultimately, what you're trying to do is you're trying to get into this range of being close to 4.0 without going over. And you'll notice here that based on these numbers, that we've assessed aggregate tolerable misstatement at 12.5 million. Now, just as a reminder, what does this mean? We're saying that once we assign the maximum amount that each of these accounts could be misstated by, in total, that's 4 times our planning materiality. How many of these accounts do you expect to be misstated? Is it closer to all of them or none of them? It's closer to none of them, okay? Some of them may be misstated, all right? But we don't expect them to be as misstated by those maximum amounts. And we certainly don't expect it to happen to all of our accounts. So in total, when we look at actual misstatements, when we start conducting our actual testing, the amount of misstatements we're going to see is hopefully much, much smaller than what we see here. If it's much, much larger, we've got a real problem. That's where we basically say, all right, you know what? Find another auditor, we're out, all right? But in this situation, that's how we assess materiality. And this is where we'd actually make our determinations. And this would be used as our judgment for our testing moving forward. Now, what does this all mean? What does this all mean once we've set all this up? That means that once we've actually come to our determinations, which we're going to come to later in this course, once we start doing testing, we're going to use this as our quantitative evaluation mechanism. to determine whether the financial statements are free from material misstatement. And with that, we are done for today. We will start chapter 4 on Friday. We'll see you then.